Hey everyone, and welcome to day 2 of our Ready Set Launch webinar. My name is Kevin Norville. I'm with the South Central Kentucky Small Business Development Center. Joining me tonight is my colleague Jim Reams, our management consultant in Somerset office.
Hello, folks.
And then also, we're very pleased to have with us tonight Matthew McCurahan from Baldwin CPAs. And so tonight what we're going to do is get into a discussion about legal entity selection. Matthew's going to share with us some issues that you need to be aware of when you're choosing a legal entity for your business. And feel free to ask questions. That's why he's here. He's graciously donated his time to be able to share with us and with you all his knowledge and expertise in regards to legal entities, and just some things you need to be aware of as you're deciding which entity to choose. So I will advise you as far as how we can communicate within the chat room. Just feel free to post your questions there. Jim or myself will be able to respond to those, and we will basically make sure Matthew's aware of those as we start the discussion. So and then after Matthew's done, you'll have a chance to ask even more questions. He's got a special offer that Baldwin is sharing with our attendees that is a very, very good deal for you if you're looking to get into QuickBooks as your accounting software. So we'll share with that at the end of his presentation as well. And then for the second half of tonight, we're going to cover some additional details about what you need to know in terms of starting your business. So with that said, I would like to introduce to you Matthew McCurahan. Matthew, we appreciate you so very much being here. Thank you very mumuch. Thank you to Baldwin CPAs for allowing you to join us tonight. And so we will turn this over to you and let you get started.
Good deal. Thanks, Kevin. Like he said, my name is Matthew McCurahan. I'm actually a staff accountant here at Baldwin CPAs. I've been here about 4 years. I actually graduated from Eastern Kentucky University with a bachelor's in management and also a bachelor's in accounting. So that's just a little bit of information about myself. I kind of specialize in some of the assurance side as well as tax here at Baldwin. Mainly construction and real estate, but do dabble in a lot of other areas as well. Like he said, tonight we're going to talk a little bit about some entity choices and how those kind of the ramifications of taxes can get involved with those, as well as just kind of the simplicity or how developing difficult each entities can be. So as you can see on the screen there are kind of like 4 buckets. The first one is sole proprietorship, which is also the simplest form of an entity choice. Then you have your partnerships, your corporations, which can be a C or an S. And then you have the LLC, which is basically a disregarded entity. In terms of from the IRS, they consider it disregarded entity, and you'll see it a little bit later. It kind of shows up on your Schedule C. But going there from top to bottom, sole proprietorship is usually the most simplest form. It obviously is a sole owner. And so a partnership, you can tell, is going to be a multi-member, and then the corporations obviously can be multi-member as well. And the LLC can be single or multi. Just going on to the next slide here. We're going to talk about LLCs here a little bit. And LLCs can be a single member by default. As I mentioned before, it is treated as a sole proprietor by the IRS, which means on your 1040, it will just come through as a Schedule C. And so that's the way you will be taxed. It'll be based on your individual rates as it flows through your tax return. It can also be a multi-member. And then if it is a multi-member, the IRS treats that as a partnership. And so the IRS will determine, and we determine how the partnership is split up. It can be 50-50. There can be more than just 2 partners. But that is how it is treated by the IRS as a partnership for tax purposes. And then an LLC can elect to be treated as an S or a C corporation. And there are reasons why you would want to do that, and there probably are reasons you would not. You would rarely see, in terms of an LLC, going to elect as a C Corp. We'll see a little bit later that the C Corp is kind of the oddball out of all of them. With the new tax law, it did get a new tax rate, a flat tax rate of 21%. But it's also difficult because it gets taxed at the entity level and also at the shareholder level when it comes through. So it's kind of a double tax system there. And so you don't really see an LLC go from a disregarded entity on a 1040, which is basically a Schedule C, to an 1120C corporation. You do, however, see a lot of times where an LLC will elect to go to an S corporation. And in my line of work, you see this a lot of times when you say a startup business has about 2 to 3 years under their belt, and they have a Schedule C, obviously, and so their income has gotten high. You've gotten past the initial startup cost lost years. So one thing about the LLC that allows you to do is we're allowed to deduct those startup costs in the partnership level, in the sole proprietor level. And so we would want to keep it as an LLC until we start making some income. And then from that, usually year 4 or 5, sometimes we elect to go to an S corporation. And one of the main reasons to do that is from an LLC, basically you're getting taxed on your net income that flows through your 1040, but you're also going to get what's called self-employment tax on your 1040. And so basically that is Social Security and Medicare tax. You can see that usually when you're working for an employer and it comes through on your W-2. You can see that you've individually paid a portion of that. But as an employer, they are also required to pay their portion of that. And so with you being a sole proprietor, you are kind of your own owner. And so they require you to pay both of that. So you end up paying about 15% extra self-employment tax as a sole proprietor and a partnership as an LLC for tax purposes. And so when you get to that kind of year 5 and you got some good net income, we usually go ahead and try to make an S election with the IRS, which allows us to go ahead and take reasonable compensation as an employee of our own business. And so one thing that obviously benefits us is instead of having to pay the Social Security and Medicare tax from an employer and an employee standpoint, you are only required to pay the Social Security and Medicare tax on the amount that is coming through on your W-2 as an employee of the S Corp. And so LLC can be tricky. Like I said, it's great for startup businesses, especially those first couple of years when we're going to have some startup costs just to get the business going that we would love to be able to deduct to help get the taxes down on those ends. And then around year 5 is usually where we see we can switch to sometimes an S Corp if it makes the most sense. Sometimes if the incomes aren't as high and we're still kind of under that 100,000 to 80,000 mark, sometimes it really does just benefit continuing to be a sole proprietor or a partnership in terms of the LLC for tax return purposes. Going on to the next slide here. Oh, go ahead.
Can I ask you a quick question there in regards to that? Because I think a lot of times people may not realize that they can sort of choose a different designation as far as the IRS is concerned. Can you talk a little bit about, is that a difficult process to change? Like if you're an LLC and obviously, let's say single member, so by default, you're treated as a sole proprietor. Is it difficult to then change that designation with the IRS so that you can be elected to be treated as an S Corp?
So it's not difficult by all means. The only kind of thing that is tricky about is timing. So if we're wanting to do it right at year 5, we're going to want to go ahead and elect that in year 4. And it is due by the March 15th of that 4th year. And so, but not difficult. It's basically just an election form. It's a 1-pager to the IRS. You just sign the bottom that you're going to elect to be treated as an S corporation. But the kind of thing you have to look at is just kind of the timing of when you want to do that versus when you don't. So,
gotcha. Okay. Thanks very much.
Yeah. So I think we're going over here. I kind of talked about this already. The sole proprietorship in a single member LLC. Like I said, it's the simplest form. It gets filed on a Schedule C personal return, which is your 1040. Like I mentioned, it's a great start. It's a place to start your small business. Then as we talked about, if it grows to a certain level, and obviously we would just want you to look into it with a specialized accountant or anything like that, just to make sure you're on the right page of when you want to switch to those S Corps or maybe even a C Corp if need be. One good thing that I probably did not mention is that there is no loss limitations due to basis. This has to do with some real estate property and also a little bit of all I talked about earlier about being able to deduct those startup costs. We have no limitations based on that being a sole proprietor or a single member LLC. I did mention that all profits will be subject to Social Security and Medicare tax. It's about 15%. And so that's obviously kind of a negative there. But one good thing is here that the last bullet point there, the 20% QBI deduction is now allowed under the new tax law. It's called Section 199A. It's a qualified business income deduction, and it is allowed for non-SSTBs, which is specialized service trade or businesses. Some of the SSTBs that are not allowed to take this deduction would be entities such as like physicians. Unfortunately, us accountants, we didn't have a good enough lobbyist to get included in that. And then there are also like lawyers, for instance, are not included in that. But some examples of individuals who would be, I know construction is a big one that is going to benefit from this new QBI deduction, as long as real estate. Real estate also, even if you have a couple single family homes that you're renting, can also qualify for this 20% QBI. And that wouldn't be on a Schedule C necessarily. That would be more on a Schedule E, but that would also qualify as well. And how that kind of works is basically, I'll give you kind of a good example here. Take a sole proprietorship, a construction company that makes $100,000, say in 2018. They would qualify for this 20% QBI deduction. So it's called a phantom deduction because it just came into the new tax law, and you would take 20% or $20,000 out of the $100,000, and that would become your new deduction that would flow through on your personal return. And so what that means is you're basically subtracting 100 minus the 20 to get you to 80,000 taxable income instead of having to pay tax on the 100,000. There are some limitations required to this. In terms of the construction example, it's limited to your maximum amount of wages. Usually construction companies might not run into this problem, but if you do have a business that does not have a lot of wages, there is another limitation. So you take the higher of either the wage limitation or this 2%, what is called basis in your adjusted costs on your property and all your equipment that you have for the base or for your business. And so usually one of those two will allow you to take the higher, and you will not get taken away from taking this deduction. You will still qualify, but that is 2.5% of your unadjusted basis in all your equipment and your property. So that's a really nice new deduction that we will have. It's in effect until 2025, and then we'll get revoted on at that time. So it's a little bit tricky, and we're still it's still fairly new. Actually, there was new regulations that came out this past month in terms of the real estate portion, because it's still just not quite under everybody's belt, and the information there that has come from the IRS is not quite fully recognizable in terms of how this is going to apply to a lot of entities that could be in the gray area, that could be an SSTB, that specialized service trade or business, or not. So it's still fairly new, but obviously a great deal for a sole proprietor or a single member LLC. I'm switching over here to a partnership, I believe is the next slide. This is probably the most flexible structure in terms of entity choice. It allows you to recourse debt. It provides basis to allow tax losses to be deducted. This is obviously talking about startup costs, and obviously if you have real estate within the partnership and say the partnership becomes broken, which happens from time to time, it's very flexible to get that real estate out and to be divided up amongst the partners with not that much tax ramifications. That is not the case for an S Corp or a C Corp that we will talk about a little bit later. But partnerships are the most flexible. You can start here as an LLC, so you have the ability to deduct losses in startup years and then elect to be a corporation later, like we had talked about. A partnership is a pass-through entity, so tax is paid on the partner's personal returns. What that means is a partnership, a 1065 return, will pay no tax at the entity level. You will actually get what's called a K1, which will pass through to your personal return, which will basically bring the net income. If you're, say, a 50-50 partner, 50% of the net income, say 100,000 divided by 2, be 50,000 per partner. So each partner would get a K1 that flows through to their personal return, and that's kind of how the income is taxed on that personal return. The QBI deduction is also allowed under here in the partnership return, which is good. And so the QBI deduction, if you take that $100,000 example that we kind of talked about earlier, and split it into $50,000 net income per person, basically that $20,000 QBI that we talked about would then also be split among the partners. And so each partner would get a $10,000 QBI deduction that would roll forward to their 1040 personal return. And then active owners also can be subject to the Social Security and Medicare tax on all the profits, and we kind of talked about that. There's a fine line, and it's around the $150,000 to $200,000 mark in terms of where you might want to start looking to maybe switch to an S corp. You can still be a partnership, and then also for legal purposes, you'll be a partnership. But the S election for tax purposes would only be for the IRS tax purpose. And so that's kind of a confusing little piece there, but it is important that you would still be a partnership for legal purposes, but for tax purposes, you would be treated as an S corp. And so we can make that election, and then that's when you would obviously have a decrease in that Social Security and Medicare tax on profits, and it would only be limited to the amount of wages that you took for that entity. Kind of moving over here to the C corporation. This one here is a little bit tricky. You don't see these a lot anymore. I do believe now with the new tax law that this will come back into effect, and a lot of entities maybe will choose to go the corporate route, basically because of that third bullet point there, the new flat corporate tax rate of 21%. It was a tiered system before. It went up as high as 30-something%, and so, but it's down to 21%, and that's just a flat rate with no tier structure, just 21% of your net income. As I mentioned before, there is double taxation with this legal entity. You have income tax on your net profit, and then also that's at the corporate level, and then at the individual level, when you want to get the net profits out of the business and pay to the owners, which are called dividends, they are also taxed on the individual's 1040. So there's that double taxation piece. And with the C Corp, the working owners must be paid employee wages, and the only requirement there is to take a reasonable compensation. And that's obviously because of the Social Security and Medicare wages and taxes in regards to that. One thing with C Corps, one reason why you might want to be a C Corp, you can do stock options, which can be an incentive for employees. You can obviously want to issue those to employees to maybe have a succession plan where you issue, say, 5% of the stock you buy back from yourself and reissue to employees to kind of get a succession plan going, that over, say, a multitude of 15 years, you would end up buying yourself out, and it would be the business would still run in terms of maybe the higher performing employees. That's one option you could see with a C Corp. But mainly C Corps, if you're wanting to go public, this is where you'd want to definitely be a C Corp, obviously, so you can have the multiple shareholders and can push out those dividends when need be. And then what we see most of the time is the next kind of legal entity is the S corporation. It's not very flexible because you could have some possible basis issues that can obviously have some effect on non-deductible losses. Working owners must be paid employee wages. This is good. This talks about the reasonable compensation. Once again, highlighting that fourth bullet point there, Social Security and the Medicare tax is limited to the wages that is being paid to the owner, not the total income. And the S corporation is also a pass-through entity, just like the 1065 partnership. It is paid on the shareholder's personal return coming through as a K1. You will see a lot of time that the S Corp status after kind of that 5-year mark and that $100,000 net income mark is where the route a lot of people go. It just kind of makes the most sense. You can take distributions not being taxed at because it's not treated like an S Corp or a C Corp, excuse me. And then we get for S corporations the 20% QBI deduction right now. And so this is the one you will see most often that I see most often in my line of work is this S corporation. But for, like I said, for startup businesses or businesses into the 1 to 5 year mark, a sole proprietorship or a partnership, or even a single member or multi-member LLC legal entity is best. Once again, the LLC, the limited liability company, are great options, obviously because of the name there, the limited liability. So that's kind of important to take a look at as well. Any questions on any of the legal entities or anything of that nature? I know we'll continue to monitor the chat and we'll look for those questions if there are any. Legal entities can be confusing, but I think the most important fact is to know kind of the tax structure for those legal entities, and obviously consult with a lawyer in terms of how your liability and things of that nature will flow through also on a legal basis. But from a tax standpoint, those are kind of the high points for each of those legal entities. And like I said, the most of the time we see S corporations and partnerships. I know Lisa Foley, one of my colleagues here at Baldwin CPAs, she deals quite a bit with a lot of partnerships, and she really likes that legal entity from a tax standpoint. And so those are kind of the tax benefits and negatives for the legal entities. Moving on to the next slide here, I kind of just wanted to talk a little bit about accounting in general.
Matthew, can I ask a quick question?
Absolutely.
And I don't know if there's any specifics in this, but sometimes we get this asked from clients. Are there any specific businesses that you can think of that would be better served as an LLC or an S corp or a C corp, or is it just depend on the partnership basis or single member or the size of the business? Anything like that?
And so it's going to depend on a kind of a wide range of things. But you definitely want to be a partnership if there's more than one owner kind of being together. That would kind of eliminate, obviously, a sole proprietor, and you wouldn't necessarily want to start out as an S corp with that. And so you kind of just hover around that partnership area, and that's based on just multi-member owners. But then again, you can also weigh the multi-member LLC that can be, from tax standpoint, a partnership as well. But to be honest, a lot of the times it just depends on your income, where it's at, and in terms of what year you might be in your business, whether it be in the early stages where you're definitely going to just want to be a partnership if there's multiple owners, or a single member LLC if there's just one owner, because there's just not very many tax advantages or legal advantages for that matter in terms of being a partnership or an S corp. But once your income hits that kind of 100,000 to 150,000 mark, tax standpoint wise, you're definitely going to want to switch either to an S corp and or the partnership from the single member LLC. And like I said, that's just kind of an election, but it just all depends on a lot of different scenarios and kind of the information provided at that time.
I appreciate that answer. That's something good that we can share with people, that it's more based on an income standpoint as opposed to a type of business that they're in.
Correct. Yes. Yeah.
And Matthew, one thing there, I want to kind of build on what Jim said, because I've heard of, we've had situations where a client has purchased property and then they want to set up like a leaseback situation where they're basically, buying that property and then leasing it back to their other business. And so sometimes they'll create two entities for that. Are there any, I know, again, we're kind of getting deep into specific situations, but is there any general guidelines as far as how that should be structured when your business really operates, let's say, as an LLC and it's maybe single member, but you're also going to buy property that you're then intending to lease back to the company, to the LLC?
Yeah, so we would definitely recommend going ahead and just creating a single member LLC for that rental property. And we can also do that with the state of Kentucky. Not to get too much into Kentucky taxes, but that would just come through as a 725, and you just pay the normal $175 of limited liability tax there. But no, it would just come through as a Schedule E. I wouldn't recommend doing anything in terms of partner unless you had multiple individuals. But for your scenario you're speaking with, we would just definitely recommend separating it a little bit from the business. That way, in terms of liability issues, you have some separation there. And in terms of a lawsuit or anything like that, it would be separated. But from a tax standpoint, yeah, it's just going to be a Schedule E, and it just be that rental property there. And obviously, with the new tax law, that's another good benefit that those Schedule E's, limited liability rental properties, will also get that new 20% QBI deduction. So,
Okay, cool. Thank you.
Wanted to talk a little bit about accounting and kind of how important it is. I cannot stress this enough that when you're starting your business, or even if you've been in business for a while now, accounting is kind of your footprint of everything that's happened within your business. It gives you pictures, for instance, a balance sheet, a picture of a certain date and how your business looks. But accounting has to be real-time data. It used to be a while ago that when everything was done by paper, you couldn't necessarily get real-time. It was kind of lagging behind. You might get a week or so if you're lucky and really up to speed with all the paper stuff. But nowadays, accounting is real-time data. And one of the ways it's used that is this cloud-based software called QuickBooks Online. I think we've all heard of QuickBooks. They used to have the desktop versions, but QuickBooks has stepped up their game a little bit here, and they're actually cloud-based now. And what that means is it's just on the internet. You just go to their website on QuickBooks Online, and you would log in, and you'd have your own company's username and password, and that's kind of how you would go about taking care of your books. But taking care of your books in the first point is very, very important. This can come into play with legal lawsuits. If you don't have adequate accounting, bad things can happen. But I think more importantly, as a business, you want to know how your business is running, where your expenses are, maybe where you can cut some expenses to increase your net income, and just to plan accordingly. But if you don't have a good accounting structure and good accounting procedures and policies, that doesn't really happen. You're not really making necessarily good business decisions if you can't see good numbers. And one of these things, talking about real-time data and talking about automating, nowadays the accounting field, I can be honest with you in terms of how I work here at Baldwin, there are not a lot of things I do anymore by hand and paper. A lot of these things are automated. QuickBooks actually has, I believe the last number I saw was over, I think it was close to 1,000 different apps that can be integrated into QuickBooks. For example, there's this one called Expensify, where we all have receipts. And so it's an app on your phone that integrates with QuickBooks. You would take a picture of your receipt, and it would go ahead and populate everything you would need to try to create that invoice or that purchase order within QuickBooks. And you would just, at a click of a button, say accept, and there you go. You've entered your expense, and it's been coded to the correct expense account automatically, all through a picture on the phone with some reading software behind it that goes ahead and does that for you, and you go ahead and automate it into your QuickBooks system. And so that's where the accounting industry is going. It's definitely moved a lot faster than we thought. I haven't been in the accounting industry that too much long, but if you talk to my partners here at Baldwin, they would say that it's been a total transformation just in the last 5 years of how much technology has changed the accounting industry. So I would just obviously recommend that you maybe take a look at QuickBooks. And like I said, we'll talk a little bit about kind of what we can offer at Baldwin here with getting QuickBooks. But truly, accounting is very important, and obviously being in real-time data is extremely important as well. So, but if you have any questions about that, don't feel free to reach out to me. I love talking about technology and how it can be just implemented in your own business and how it can streamline processes. Because obviously, you want to do business, and you've gone into business because you're good at doing something. Not everybody is necessarily good at accounting, but with a lot of, let's say, software, as long as you know how to use it, it can give you that time you need to spend in your business, not necessarily working on your books 24/7, which is can be a headache for a lot of people. So that's something very important there. Going on to the next slide here, just kind of a little bit about what Baldwin can offer here We do have a back office where we can do in-house accounts payable and accounts receivable. We also do here in-house payroll as kind of like an outsourced service for your business entity. And a lot of people are going that route nowadays. It's complicated, and you have to hire staff internally, and sometimes the outsource there, whether it be through us or paychecks. It's just so much easier nowadays to get that outsourced. One main reason, not just thinking about Baldwin here, but paychecks or any of those outsourced payroll services, they're going to go ahead and file your payroll tax returns. And to be honest, those can be a nightmare to keep track of. And you want to make sure you're in compliance with all those payroll laws and regulations because the fines can get pretty hefty if you're not. So I just encourage you to look at either paychecks or us, for instance, or any of that nature in terms of a payroll service, and just look at the cost benefit of doing it in-house and all the time you're spending and paying individuals versus looking somewhere else. Here at Baldwin, we've also gone to more of an advisory service role, CFO, a certified financial officer role. And so we kind of changed from doing a lot of the normal tax accounting and bookkeeping and things like that. We obviously still do that. And if that's a need of yours, we can still do that. But we definitely like to go ahead and just kind of be a function of your management team and help you make overall good decisions on where your business should go. That kind of leads into that advisory piece, that third bullet point, looking at industry measurements, keeping the management team accountable. And obviously just giving knowledge here and there about the accounting, kind of the information you're looking at, where you would stand on a year-to-year, quarter-to-quarter basis. But yeah, that's definitely something Baldwin as well will offer and help you all with. The last thing I wanted to mention is kind of going back to the previous slide with QuickBooks. QuickBooks does do a lot of discounts on their pricing. You might see from time to time a discount that says, hey, QuickBooks is only $25 for this 12-month period. That's great. Discounts are great, but those discounts don't last forever. One thing you can get through Baldwin using us as kind of the seller of the software here is that we get what's called a discount, a business entity discount, as kind of a wholesaler of QuickBooks. And so we can actually offer it as a discounted rate that stays there the entire time. There will be a sheet of paper that could be linked, I think, in the chat. I think Kevin maybe mentioned that, and or it will be sent out in an email afterwards. And that kind of describes kind of what I'm talking about here. The standalone price, just for an example, for the Essentials package is $35. And you're probably asking what kind of is in the Essentials package. It includes things like track your income and expenses, send unlimited estimates and invoices, downloading your transactions for your bank and credit card accounts. Basically, the essentials of what you would need. A basic, simple startup business or a business that's been in years, probably 1 through 6, would probably be within the essentials. But really, the only thing the plus adds is inventory. So if you've got a lot of inventory, you'd be wanting to look at the QuickBooks Plus. But for the essentials, for the standalone price from QuickBooks pricing is $35. Through Baldwin CPAs, you can get it at $26, and that $26 a month would actually stay permanent, and it's not just an end of 12-year or 12-month discount and then drop back to normal price. So if you have any questions about that, don't hesitate to give me a call. If you have any questions, and we can definitely discuss that if that's something you're interested in. But I would definitely just recommend looking at something like QuickBooks or any accounting software, as it can definitely make kind of the headache world of accounting much more friendlier and much easier. One thing I did not get to mention or forgot to mention about QuickBooks is it links directly with your business bank account. And also, as soon as the transaction goes through your business bank account, will upload to your QuickBooks and comes to you directly kind of via your phone, and you can accept or decline that transaction and where you want to code it or not code it. So a lot of handy processes there, a lot of streamlining there, effectiveness and efficiencies that can be gained in using kind of the QuickBooks approach for accounting. So that's kind of all I had. Just wanted to talk a little bit about some legal entity choices and some of the tax ramifications, and then provide some feedback about accounting and how important it can be and will be and should be for your business, and just kind of the things that Baldwin can offer.
Awesome. Thank you, Matthew. Jim and I will kind of pop back up here on the screen. We want to just have just a minute or two to let folks ask questions if they have those, and feel free to type that in the chat room right now. One thing I know that I wanted to ask you about specifically, Matthew, is some, I guess, common issues that we oftentimes see with businesses that are starting up. Either, you kind of talked about the importance of, making sure your bookkeeping's right from day one, because you don't want to, get into this several months down the road and then realize you've got a mess on your hands. But one of the issues in particular that I think we see oftentimes that people may not realize how serious it is this concept of commingling of assets. Can you talk about that a little bit, as far as if a business owner, takes money out of their business account to pay for something personal? What does that really mean, and why should they not do that?
Yeah, so that's a very good point. It more goes towards a legal kind of environment where, if, say, you were getting sued for something and you had that limited liability company, but you were paying for personal things over there, if you were to commingle your assets, they're going to come back and say, well, this is not really its own limited liability company. You're kind of feeding it to your own personal life as well. And so they basically will come along and say, no, this is an extension of yourself, and we're going to go get that as well from a limited liability standpoint. They would ignore the LLC piece because of your commingling of assets. So it is very important to kind of keep those separate. Go ahead and take those distributions and draws from your account, just to make sure that you have a paper trail of dispersing money from one entity to your own personal bank account. There's no problem with taking a draw, but there could be a potential problem if you're just going ahead and paying for personal expenses through your business bank account in terms from a legal standpoint.
Yeah, makes sense. What are do you have any common things that you all see at Baldwin that tend to trip people up when they're just getting started with their business? Maybe it's, they don't set up QuickBooks correctly, or they're just they don't have adequate controls in place. What's sort of maybe one or two of the common things that you all see that people can really just need to be on the watch for when they start their business?
Some of the things that we see, I think right off the bat, I would say, is sometimes trusting your employees too much. I think you'd be like, well, you're not going to trust your own employees. Well, I don't mean that. You can trust your employees for sure, but you definitely need to have those controls in place. And so one basic control that I would see in a small business that I would want to look at is if you have someone in charge of making purchase orders, that you as the owner are receiving the bank statements and reviewing those transactions, and or also just signing every cash disbursement, the check that you write that goes out of the business. That way you're reviewing what's being spent. You're okay with what's being spent from the business. And so that's kind of one right off the top that I would think. And then another, I think, would just be, it's going to be in a little bit of a weeds here, but the chart of accounts, the basic chart of accounts in your QuickBooks. You might not think it's very important, but it actually is. In terms of getting things in the right spots, whether it's an asset versus a liability, whether it's an income account, they all have different jurisdictions and kind of how they get reported on a balance sheet and income statement. And if those aren't set up right, and you go to send a balance sheet and an income statement to, say, a bank for something, for lending purposes, if those aren't in the right spots, it's not going to look anything where it should be. So chart of accounts, it's real basic, but it's important getting that structure set up.
Yeah, definitely see that being an issue from time to time. I think a lot of times what we see is, when folks start their business, they're so eager to dive in and get started. And, let's face it, bookkeeping is probably not the reason they went into business to begin with.
That's
so
right.
That would be the last thing they really devote much time to. And so that's why we like to have folks like yourself that we can list as a resource that's available to basically, take over the bookkeeping for them. And especially if they're starting off with employees. That's one of my number one pieces of advice is, if you're going to, anything else that you've seen?
I was just going to ask the same question you kind of ran with about how important bookkeeping is, but I believe we've already answered that. It's just from the beginning, it can't start soon enough.
Yeah.
And I think one thing to mention is that if it's set up right on the front end, going to the right spots because it's already set up correctly. So it gets you all that time to spend out doing what you want to do in the first place and why you got into business, and not having to spend time in full with kind of the bookkeeping aspect of your business.
Makes sense.
Quick that way. So you have to take the time to do it. So
yeah. Well, I made a special note of that Expensify. I didn't realize that Expensify tied in or integrated at that level to QuickBooks.
It did.
I know several folks who are using that, and it's a great app. Here on the screen, if folks want more information about Baldwin CPAs and how you all can help them, I encourage them to reach out to you. But again, thank you so very much for joining us, and we really appreciate your time.
It was great speaking with you all, and I hope you have a great evening, and let me know if you have any questions.
We'll do it. Thank you, sir.
Take care.
All right. So as we kind of transition here, we will move to phase 2 of our segment tonight. And so what we're going to talk about, hopefully, is going to be your questions. So if you have questions, we want you to ask those of Jim or me and post that in the chat room. But in the meantime, what I want to do is pull up another set of slides, if I can get them going here. And we're going to talk just a little bit about the agenda for the rest of the evening. So we obviously had some great information there from Matthew in regards to legal entity selection. And while he focused a lot on the tax implications of legal entity selection, you'll recall from our first session, we looked at some of the legal issues in regards to entity selection. So it's a double-sided coin there. No matter which legal entity you choose, it has tax effects and it has legal effects. Obviously, the reason you want to choose something like an LLC is for that limited liability protection. But as Matthew noted, there may be occasions, especially after year 4 or 5, or when you start making some significant money in the business, that it makes sense to convert that format to an S corp for tax purposes. And so I think he did a great job kind of leading us down that path and showing us how that decision will affect you maybe years from now. But the good thing that I think we take from that as well is that you're not permanently locked in. You can basically choose to change how the IRS treats you for tax purposes, which is encouraging. Mm-hmm. Jim, anything you would add to what Matthew said?
I think he covered it quite well.
Okay, very good. So as we move on, we're going to talk a little bit tonight, just a little bit more anyway, about financial management and bookkeeping, right? There's a lot of things that business owners get into problems with when they don't take care of the books. And so while Matthew explained a couple of those, I know that Jim and me, we see a lot of things, and we try to help people avoid some of the mistakes that others have made. And so that's why we really emphasize, the importance of financial management and bookkeeping. I can't tell you how many clients that call me up and maybe they've been in business for a couple of years and say, hey, I'm having some issues. We say, well, how is your business doing? Are you making money? And their answer is, well, I don't know. I haven't done my taxes yet. So that to us, it's a big red flag. That's one of those things that it's just really disturbing if we hear that. So we hope that you never let it get to a situation where you don't know how well your business is doing until you do taxes. The money that you have in the bank in your checking account does not equal profit. So that doesn't mean your business is making money just because you have money in the bank. Doesn't mean that you're losing money if you don't have money in the bank either. That can sometimes just be a cash flow issue. But keeping on top of your bookkeeping is very important. Jim, I see we got a question in the chat room from Tabitha about, would a sole proprietorship still need a separate bank account from their personal bank account? A very good question, Tabitha, and I should have gotten Matthew to chime in on that. But here's the thing, if we remember what we talked about with a sole proprietor, in a sole proprietor, you do not have any of those liability protections that an LLC or a corporation would have. Therefore, in terms of from the legal side, and let me preface this by saying I'm not an attorney, so I can't give you legal advice. But in regards to how the legal structure is set up of the entity, a sole proprietor is the business, and the business is the sole proprietor. So there's no liability protection to begin with. So no, there would not technically be a need for a separate bank account for a sole proprietor. Now, Jim, I'll bring you in here on this because I know I ran into this early on. I started a small business at one time, and I was doing web design. And I think the bank told me, but you tell me if you've heard differently, that as long as I was receiving money that's in my name, then basically I did not need a separate business bank account. But if I were doing business as another name, they wanted me to set up a different checking account for that. Now, maybe that's just the bank I was at. I'm not sure, but I don't know if you could speak into that at all as far as what your experience has been.
Any business related activity, if you're going to be a sole proprietor, for one thing, if let's just say that you're doing business as ABC Design, and your name is Joe Smith. Well, if somebody writes you a check to Joe Smith, you can go deposit that in your regular bank account. You can cash it. You can do whatever you want to with it. But if somebody makes you a check out to ABC Design, you can't deposit that in your personal checking account, nor can you cash that check. So you would have to have you wouldn't have to set up an LLC to be a sole proprietor, but you would have to have an account that is Joe Smith doing business as ABC Design.
Yeah.
So you would need that in order to be able to negotiate that check. On the other hand, I think this kind of goes back to what we were talking about before about the commingling of funds.
Yeah.
If really, like you said, you don't necessarily have to have a separate account, but I don't know why you would ever not want to have a separate account for a business account. It's just, to me, it makes much more sense.
Now, I can think of one reason. Some banks charge a pretty high monthly fee.
That is true.
If you open a business account, I know just a couple that I've went to or heard stories from that, sort of that minimum level was kind of $1,000.
That is true.
And
that
if
is
you
true.
drop below that, then those fees kick in, and you're paying $15 a month. It's just going to eat up all your cash.
That is true.
That's
where it definitely pays to shop around.
That's right. Yeah.
When it comes to business banking.
Yeah, definitely makes sense. Yeah. But good question, Tabitha, because that's one that a lot of people probably deal with especially when they're starting out. So just to summarize there, if you're doing business as anything other than your name, then yeah, you're going to have a separate business account. But if you're doing business just as your name, and people are writing checks to you with your name and not a business name, then you should be okay. But Jim and I had kind of said it helps from a record keeping standpoint to keep all that separate for sure. So moving on to other things in regards to bookkeeping, I think the example there of commingling of assets, the one that I use a lot of times was the issue of, okay, we're going to go to Gatlinburg for the weekend. I'm going to use my company card and pay for the hotel room and dinner and a show and everything of that nature. And that commingling of assets, if you are an LLC or a corporation and have some of that legal liability protection, when you commingle assets or when you use the business as your own personal bank account, you're basically destroying that liability protection, or as an accountant or an attorney would call it, you're piercing the corporate veil. And so that's why it's important. It's not saying you can't go to Gatlinburg for the weekend, and it's not saying that the business can't pay for it, but the business needs to pay you, and then you need to turn around and pay for those expenditures and not have the business pay for that directly. So it's a matter of bookkeeping and proper record keeping to just make sure those controls are in place, and that way you can ensure that your liability protection remains intact. In regards to another issue as far as financial management and bookkeeping, when we're talking about withholding information, withholding accounts for employees, if you do get to the point where you add an employee, you are then setting up a withholding account that is not your money. So you are withholding dollars that either go to the state or federal government to pay payroll taxes for that employee. Now, where we've seen issues is where if times get difficult in a business, sometimes a business owner will take money from those accounts that is set aside for withholding purposes, and they'll use that in order to pay the bills. Well, you cannot get into that situation. That money is not yours anymore. Once you have withheld that, basically the only thing you can do with it at that point is to turn it over, and that goes for sales tax as well as withholding account information for employees. So you have to be very careful about that and make sure that you never get into a situation where you are spending dollars that you have collected from your employee's paycheck in the business, because that can result in some very serious consequences for your business at that point. Another area we're going to talk about, and I'll just cover these topics here real quick. We're going to talk about employees versus independent contractors. We're going to go into some more detail about marketing, in particular, some ways to market your business online. And then hopefully, like I said, we'll answer some more of your questions. So let's kind of dive in here for a moment to talk about this age-old question of, do you have employees or do you have independent contractors? So the concept here is pretty straightforward as far as the IRS is concerned. And you may ask, well, why does the IRS make this distinction? Well, it comes down to taxes. Are you owing? Do you owe the IRS taxes that you should be withholding from an employee, or are you saying that employee is technically an independent contractor and therefore you don't have to collect any tax? They're responsible for their own income tax. So these are some of the characteristics. So we'll just run down the list. An employee is paid hourly or by salary. So if you're paying someone either by the hour or on a salary basis, that would pretty much define them as an employee. However, in contrast to an independent contractor, who you typically pay upon completion of a project. So that independent contractor, you may say, I need you to come in and do this job, and I'm going to pay you $1,000 to complete it, and you'll pay them at the completion of that project. So that's one of the differences between an employee versus an independent contractor. Another difference here is the employee uses the employer's materials, tools, and equipment. So an employee, if they're doing a job, they're typically using the equipment that the employer has provided. An independent contractor, on the other hand, is basically providing their own materials. They're bringing their own tools, their own equipment to the job in order to do it, and they're not relying on anything from the employer. Employees typically work for one employer, makes sense, whereas independent contractors normally perform work for multiple clients. It's another distinguishing characteristic there. Employees have generally a continuing relationship. This is where sometimes you can get into trouble as well by trying to say this person is an independent contractor, but yet they've been an independent contractor working solely for you for 5 years. That sets off some red flags with the IRS. Another characteristic, the employer decides the manner and means of performing versus the contractor deciding the manner and means of performing. So what that means is, are you providing direction to the person performing the work? If you are, in other words, if you're telling them what time they need to be there, when they need to report to work, when they can leave work, how they're performing the work, that typically means that's an employee. If, on the other hand, you are just saying, I need you to do this job, and can you get it done in 3 weeks? Yes, that's great, okay, but you're not providing that oversight or general direction to that person, then maybe they are, in fact, a independent contractor. So, and that kind of relates to this last one too. The employer determines the work performed, whereas versus an independent contractor situation when the contractor and the client together sit down and agree upon what the project is going to include. So employee versus independent contractor is a very common issue in regards to certain business types. Usually for, let's say, a retail store, it's probably much more clearly defined. You're basically hiring an employee to come in and work your store. But you often see the independent contractor situation claimed for, let's say, like landscape companies. They may have several crews of people that go out and do jobs, and they may say, well, I don't want to have to pay, I don't want to be responsible for unemployment insurance, workers' compensation, or any of their payroll taxes. So therefore, you're an independent contractor, when in fact, they're using the equipment, the materials, they're under the direction of a boss, which is an employer. And so that technically would not be a legally correct relationship to call them an independent contractor. Okay, does that make sense? Jim, anything else you would add to that you've seen?
Just to say that that's probably one of our biggest questions when people start hiring people as to whether they need to be an employer or an independent contractor. So it's very important to know the difference.
Yeah, we do see that quite often. Let's talk about marketing for a few minutes. Marketing is always an issue for businesses, especially for startup businesses, because you need to find a way to get people to know about your business and to be able to know, like, and trust you enough to do business with you. The landscape has changed drastically over the last 15 to 20 years, and really significantly over the last 10 years, transitioning away from what we would call traditional marketing into what now is really referred under one umbrella as digital marketing. So what we're going to talk about tonight is really just the different types of digital marketing, because these are very cost-effective ways to reach your target market. And I think most business owners now, sort of when they think about marketing, their mindset goes immediately to the digital marketing arena as opposed to traditional marketing, whether it be billboards or radio ads or TV, whatever. So let's talk about these different types, and I'll give you just an example of each. SEO, as it's abbreviated, is called search engine optimization. And so this is the idea that you can modify or optimize your website to be more easily found by customers online. And so this is a practice that is probably as much art as it is science. And you have to have a website that's pretty robust to be able to really see benefits from SEO. So if you set up a Wix website, let's say, nothing wrong with Wix, it's a great platform to start out on. But let's say you use Wix and set up your website, and maybe it's 4 or 5 pages, and you don't have a whole lot of content on there. SEO is not really going to get you a lot further down the road. In fact, you're probably going to have a much better time investing your time in some of these other marketing methods besides search engine optimization. If, on the other hand, you have a website that has 30 or 40 pages of content, maybe it has, product catalog, and you have product descriptions, and you want to reach a much larger audience, then you can see some significant results by investing in search engine optimization efforts. So search engine optimization is sometimes considered a little mysterious, because oftentimes people who perform SEO almost act like they're snake oil salesmen. They promise everything. Oh, I can guarantee I'll get you on the first page of Google. When in fact, that's very difficult, if not impossible, to make that guarantee. And so you have to be cautious when you're dealing with SEO, and make sure that you understand what you're paying for and that you have a way to measure the results. And as long as you go into that situation with your eyes wide open, you'll be fine. As we transition and look at local search is, Google's done some things here recently that has really revolutionized the ability to take advantage of local search in the digital marketing arena. And that's done primarily through their product called Google My Business. And we're going to go through that in a little more detail, but I want to introduce it right now and then kind of show you some examples here in a moment. The next area of digital marketing that we talk about is content marketing. And what we mean by content marketing is maybe you have a blog on your website and you're writing an article, once a day, maybe once a week. You're basically displaying your knowledge about a particular subject, usually whatever arena or whatever industry you're in, by sharing content. And that establishes you as an expert, as a thought leader in that particular industry. And so by having all this content that's regularly generated, you can then share that through social media channels which will then allow people to naturally be drawn into your website to learn more about you and to learn how you can do business with them. So content marketing is really time consuming, or it can be, but for people who enjoy writing, who enjoy producing regular content, it doesn't always have to be writing or written content. It can be video content. Certainly you can do, take advantage of a YouTube channel or your Facebook Live channel. All of those things are situations where you're producing content, whether it's written or spoken or video. And so that allows businesses to really reach out and connect with people who are searching for the issues that they're addressing through their content. So content marketing is relatively new, but it kind of takes a lot to get started, right? Because you got to be able to type a lot of content or produce a lot of content to really populate your website. Social media marketing is probably what most startups are familiar with, and probably top of mind for social media marketing would be Facebook. But certainly it's not limited to Facebook. You've got Facebook and Twitter and Instagram, and you've got other platforms as well, even including YouTube. But the key factor there is really, while many people say, well, it's free to promote your business on Facebook, it's not really free. It certainly takes your time. And if you're going to do it right, if you're going to do it on a scale that really has an impact for your business, you're probably going to have to spend some money to pay for some ads. And those ads will allow you to connect with more people across your platform, so that you're not just reaching, maybe a couple hundred people that are local, but you're able to reach people much further away from your business that's physically located. But also you're able to connect with people who really want what you have to offer. So social media marketing is a great way to approach your marketing. And then probably one that gets neglected maybe more than some of these others is email marketing. The great thing about email marketing is, look, it doesn't cost you anything, or very, very little, to deliver 1,000 email messages a month. And email marketing is very effective still in terms of being able to connect with your audience and put before them an offer or a call to action to do something. Email is a great way to do that. So if you're not collecting email addresses right now, that's a wonderful thing to start doing right now, is build your email list, because you can use that to convert to actual paying clients as you grow your marketing efforts. So that's kind of the overview of digital marketing as a general concept. Now I want to go into a little more detail here about Google. And talk in some more examples of Google My Business and how you should be taking advantage of this if you're basically any type of business that as long as you're not just 100% online, as long as you have a physical location, or maybe you serve clients at their particular location, you want to take advantage of Google My Business. So the key thing here to realize is that people are already searching for what your business provides, whether it's a service or a product. They're already looking for that. What Google My Business helps you to do is helps you connect with those people more efficiently. And it makes sure that your information is presented correctly across a multitude of platforms. So whether it's when they're searching at home on a desktop, whether they're out and about on a mobile phone or tablet, they're able to find your information, and the information appears correctly across all devices. So a few interesting stats here about why Google My Business is important. 50% of consumers that are conducting a local search on their smartphone will visit a store within a day. So this is not saying that they're doing research now and they're going to act on it much later. They're actually doing research and they're acting on it within the same day. So Google My Business helps you capitalize on those customers. 80% of customers won't look beyond the first page of a Google search. And 60% of all clicks end up going to the top 3 search results. I certainly know that's true for me. If the information that I'm looking for doesn't come up in the first page, I probably start over with a new search. I very rarely, if at all, go to the second page of results. So it's key that you're on the first page. And it's even more important to be in the top 3. 85% of consumers trust online reviews just as much as personal recommendations. That's something that's drastically changed in the last few years. So it's not saying that they trust online reviews. It's saying they trust them as much as they trust a personal recommendation. So reviews about your business, whether you're aware of them or not, are impacting your business. And so through the Google My Business platform, you can not only be made aware when someone leaves a review, but you have the ability to respond to those reviews as well. Very key feature of Google My Business. And then finally, one of the most disheartening pieces of information about Google My Business is only 37% of businesses have actually claimed their Google My Business listing. Now, Jim and I are, as part of our relationship with the SBDC, we're partners with Google in the Google My Business platform. And as part of what we've done, we've taken some training, we've gone through some exercises with them. And so now we're part of what they call the Trusted Verifier program that allows us to work with business owners to verify their Google My Business listing so that we can get you up and listed on Google and hopefully optimize that listing so that you're going to show up in that, what they call the top 3 or the 3-pack of Google My Business listings. So this screenshot that we're looking at here is an actual client of ours in Richmond. This is one of our, it's a very small bridal store, bridal boutique in Richmond. And so we started working with her in November. But now you can see this is a 28-day report showing the significance that this effort is made in regards to getting eyeballs on her business. So you can see here in 28 days, she was able to have her business showed up 9.8 thousand times in Google search and 545 times in Google Maps. 540 people found her listing by basically typing for her business name, but 9,500 people saw her listing because they were searching for a particular product or a category that her business listing was included in. So again, huge numbers. And then what did those people do when they actually viewed her listing? Well, 78 asked for directions, 495 clicked on to visit her website, 62 people actually clicked the call button and actually called the store, and then 23,000 viewed photos that she has posted on as part of her Google My Business listing. So these are some significant results. We were pretty pleased and to be honest, kind of surprised that it was that significant. Again, this just shows the trend over time of what people did as far as visiting the website, requesting directions, or calling. The photo views, as you see, started sort of mid-November, but then really picked up in January. And that's where she's seeing a ton of business come from, is because people are looking at the photos that she's posted as part of her profile. This goes to the example here shows how many people saw her listing on Google search versus Google Maps. So those are some real world examples, some real life examples of how your Google My Business listing can drastically improve your ability to connect with customers who are looking for your business locally. So the example I always use is when I go to a town I'm not familiar with, one of the first things I do is I take out my phone and I look for restaurants, right? And so maybe you do this too. You may look for an Italian restaurant, or maybe you're looking for, a burger place or whatever it is. But Google knows where you're at because they know, well, let's face it, they know a lot. But they know where you're at based on your GPS and your phone. And so as a result, people are already searching in your immediate area for the products and services that you have to offer. All that you're doing with Google My Business is you're making sure that your business shows up when they're actually searching. So it's very simple to get started. You can actually go here to the web address, gybo.com/business, and you can start the process of claiming your business listing because it's very likely that your business already has a listing. It's just not been claimed yet. This is an example of what the process looks like when you go to claim your listing. This is an example here from Richmond, Madison Gardens. And so just to show you a little bit about what that profile looks like, you can see, obviously, it has pictures, it has user reviews, it has directions, it's got their phone number, of course. It shows the reviews here. It shows photos that have been uploaded, not only by the business owner, but also by customers. So you get to see basically what pictures people have taken while they're at your business, and they've uploaded those. Again, just showing different pictures here. These were all uploaded by the owner, and these were all uploaded, well, some of them were uploaded by the owner, but the majority of them were uploaded by customers. Yeah, I'm making Jim hungry. Me too. So when you go to claim your business listing, Google's going to come back and tell you either one of three things. You're going to get a green check mark, which means, hey, you know what? Great work. Your listing is complete. make sure you keep that information up to date. The second option is the yellow question mark, meaning, hey, you know what? We've got some information on you, but it might not be 100% accurate. So they want you to verify that information. Maybe they need a verification of the phone number, the business address, your office hours or store hours, whatever it might be. You have the ability to put all that information in. And then there's the rare instance where Google doesn't know anything about your business. Maybe you're brand new, just got launched, a week or so ago. In that instance, you're actually creating your listing from scratch. So you're starting at square one. So that's a brief overview of Google My Business. One of the key areas that I want to emphasize here is that it's a very simple process. When you start there and go to gybo.com/business, you'll see the process and how easy it is to get your business listing created and then optimize it for people to be able to find you on Google My Business. But don't hesitate to contact Jim or me and let us help you. We can make you we can make sure that your business gets verified, because that's the typical process where it sometimes gets a little tricky. Is Google does something that's very unlike Google in that as part of the verification process, they actually mail you a postcard. And so sometimes that takes a week, sometimes it takes 2 weeks for you to get that in the mail. Sometimes it gets lost in the mail. And so without that postcard, you can't verify your business, and then it doesn't appear in the search results on Google Search and Maps. So one of the things that we can do is we can actually verify your business for you. We can actually come to your location, verify it at that same time using an app that we have that connects us directly to Google. So feel free to reach out to us for assistance in creating, verifying, or optimizing your Google My Business listing. Jim, is there anything you would add to that?
I think you've covered it completely, Kevin.
Okay.
Just to, hammer home how important that Google really is to business today. From some of the meetings that we've been to, not taking away from anybody's website, but Google has really become even more important than your own website. As much as we've heard, because for lack of a better term, I mean, Google steals from everybody else's website, and
Sure.
it benefits the business owner, but it also benefits Google. So that's why they're doing that. So, and I think that's probably why a lot of their tools are free, is because they're using your data and it's helping both of you. So, but I can't emphasize enough how important it is.
Yeah. Good thoughts. So let's talk about next steps. You've heard already from us talking about the basics of starting your business, how to evaluate your business idea. Just to kind of recap, we covered feasibility. We covered a little bit about how you're going to fund your business, how you're going to get the money that you need to get it started if you need to borrow money. Certainly, if you could start it without borrowing money, that's great. We talked about business planning and what goes into a business plan. We then sort of turned the attention to legal entity selection to help you see that there's several different options available. And ultimately, that comes down to how do you balance liability protection versus tax advantages. And so we learned a lot about that tonight. So now, what is your next step as a potential business owner? Well, we certainly hope that you're ready to launch your business at this point. But understand, too, that you may still have questions. So what we want to do is make clear that a path that we have to moving forward is sort of our next step of meeting with your local small business development center. So we would encourage you, if you're ready to register that business, if indeed you're choosing an entity that requires registration, that you schedule an appointment with Jim or schedule an appointment with me. We'll sit down with you one-on-one, or if we can't get to where you're located or you can't get to where we're at, we can actually do it online using Zoom or another platform where we will help you walk through the process of registering that business entity with the Secretary of State. You'll recall that if you're doing like an LLC or an S Corp, we also have to get what's called an employer identification number, which is something that comes from the IRS. And then also we would help you set up any revenue accounts that you might need at the Kentucky Department of Revenue. I don't know that we talked a lot about it, but one thing just to remember there is if you're doing anything in regards to product sales, then you're required to also get a Kentucky sales and use tax number, which is part of the registration process that we can help you with. Beyond that, really it comes down to, do you need a local business license? There may be, based on where you're located, a requirement for you to obtain a business license locally. Many times that will be at the city level, but sometimes you even see that at the county level as well. So it just depends on what type of business you're opening and where you're located as to if there's that requirement. But the good thing is the SBDC services there's never a fee involved with working with SBDC. As we say, your tax dollars have already prepaid for our time. So we encourage you to as you're considering what your next step is, please take this time to schedule an appointment with us, and we can walk you through the next step for you. If that next step includes financing, Jim, do you want to talk a little bit about what we would, how we would like to proceed there, and what would be involved in pursuing financing?
Sure. If like you said, if you are interested in pursuing financing, we would like to help you with any financial projections that the bank's going to require. Setting up a business plan, you're going to need one of those. Anything as far as the projections that we can go through Live Plan to set you up with a Live Plan account, and it's so streamlined. I can't sing its praises enough how beneficial it's been to our clients to be able to use Live Plan, and also from the reports that it comes out with, and being able to go to a lender. It's really is going to make the process much easier and more beneficial for any type of business. It really is.
So really the next steps in your court, as far as how you want to proceed. If there's additional questions you have, we'd love to sit down and talk with you in more detail and get those questions answered. If we don't know the answers, we'll certainly help you figure out or find the right answer for that. Beyond that, once you do get funded, the next step is really opening for business. And there's some things there that you would want to pay attention to, especially if you're hiring employees or maybe you're looking to set up your QuickBooks and you need help doing that. Jim and I can direct you to some resources where you can connect with a qualified accountant who can help you get off on the right foot there and get started correctly, so that you don't end up with a situation later on where you're having to go back and fix things. So it's always important to start off correctly if you can, and avoid any hassles later. So we wanted to kind of end tonight. We're coming up on basically 90 minutes here or close to it. But thank you all for attending. We appreciate your willingness to join us on this evening and actually connect online. We hope this has been convenient for you. We hope you enjoy this format, the webinar format. But we also desire your feedback. So we're going to be sending out a link to a survey that'll go out tomorrow. So we ask you to complete that survey for us and just let us know what you think. Tell us how we can improve it. What things did you find most beneficial, and what things maybe you didn't find as useful for your particular situation. We also encourage your comments and suggestions. If there's other types of training that you would like to see us provide, let us know that in the comments as well. But Jim, I'll take one more look here to make sure I don't see any other questions in the chat room. But if you do have any questions, feel free to type those in as we wrap things up here. But otherwise, let me say that we appreciate, again, Matthew joining us this evening. Appreciate Baldwin CPAs for them sharing their expertise in regards to legal entity selection. Thank them very much for that. Be sure and check out their very generous offer on the QuickBooks discount that we shared with you earlier. Being able to save money on QuickBooks is a great thing. So having said that, thank you all very much for attending. We appreciate your time and attention, and we look forward to working with you in the future.
Thank you, guys.
See you all. Have a great one.